Want to own shares in a world-class business paying one of the safest dividends you'll find? Like the idea of benefiting from a mega trend playing out right now? Would you like to get a good deal on a Dividend Aristocrat that's growing its dividend at a double-digit rate? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing millions of customers with home improvement products. You already know that there's been a mega trend playing out in the United States over the last year or so. That mega trend is one where people are leaving cramped urban apartments for larger suburban homes. And what does that mean? It means more people buying home improvement products. It also means more profit for this company and bigger dividends for its shareholders. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Lowe's Companies Inc., which appear to be trading at a significant discount today. Lowe's Companies Inc., stock ticker LOW, is a large home improvement retailer based in the United States. Founded in 1921, Lowe's is now a $134 billion by market cap retailing behemoth that employs 280,000 people. They operate nearly 2,000 stores in the US and Canada. The typical store averages around 110,000 square feet in size and offers 35,000 different products. In addition, they offer hundreds of thousands of products via their special order system and e-commerce channel. There's a huge trend that's been playing out in the United States for the last year. It's one where people are starting to move away from cramped urban housing in favor of more spacious suburban homes, and this has seemingly been induced by a variety of factors, including, but not limited to, the pandemic. While this trend has a lot of knock-on effects, one of the most obvious beneficiaries of such a trend is a home improvement retailer. That's simply because large homes require significantly more upkeep than a small apartment, not to mention the fact that it introduces the pride of home ownership and desire for customized upgrades. As the second largest home improvement retailer in the world, Lowe's is reaping rewards. That should translate to more profits and bigger dividends for shareholders. Already, Lowe's has increased its dividend for 59 consecutive years. That's one of the lengthiest dividend growth track records in existence, making them a dividend aristocrat more than twice over. Their 10-year dividend growth rate is an impressive 18.9%. And while you might think there'd be a dramatic slowdown at nearly 60 years into dividend raises, you'd be wrong. Their most recent dividend increase, announced just in May, came in at an astounding 33.3%. With a low payout ratio of 34.8%, there's a lot of room for more double-digit dividend increases. Plus, the stock yields a market-beating 1.7%, which is right in line with the stock's 5-year average yield. Looking at business growth, Lowe's grew its revenue from $50.208 billion in fiscal year 2011 to $89.597 billion in fiscal year 2020. That's a compound annual growth rate of 6.65%. I see that as a very strong top-line growth rate for such a large sales base. Meanwhile, earnings per share increased from $1.43 to $7.75 over this period, which is a compound annual growth rate of 20.66%. We can now see where that huge dividend growth came from. It came from huge earnings per share growth. A rather substantial buyback program drove much of the excess bottom line growth. They've reduced the outstanding share count by 41% over the last decade. Moving forward, CFRA is forecasting that Lowe's will compound its earnings per share at an annual rate of 5% over the next 3 years. I'm not real sure why CFRA has such a low figure here. It doesn't really square with the historical growth rate, the current sales environment, or any of the glowing praise CFRA heaps upon the business. To wit, CFRA says this, and I quote, "Lowe's is still in the middle innings of a transformation with improved sales execution, inventory controls, better supply chain, and revamped stores." They also say this, and I quote, "Lowe's is executing better in our view, especially on customer service and store management," unquote. So if they're executing better, I'm not sure why there would be an expectation for such a meaningful slowdown in growth. If we look at Lowe's 5-year earnings per share compound annual growth rate from fiscal year 2011 to fiscal year 2015, before the urban flight started to occur, it was over 17%. On the other hand, the last 12 to 18 months has been rather exceptional for the business, as there's been a bit of a pull forward effect on sales. I think Lowe's should do at least as well as it historically has, but there's a good chance the business does even better moving forward, and that would easily set them up for double-digit dividend growth for the foreseeable future, especially after factoring in the low payout ratio. Moving over to the balance sheet, they have a rock-solid financial position. The long-term debt-to-equity ratio at 14.38 looks very high, but that's because of low common equity, not an unsustainable amount of long-term debt. Their long-term debt load of about $20 billion is actually quite low for a $135 billion company. Meantime, the interest coverage ratio, slightly under 10, shows that the business has no issues with servicing its debt. Profitability is robust with some improvement of late. Over the last 5 years, the firm has averaged annual net margin of 5.07% and annual return on equity of 119.41%. Net margin has been nicely marching upward over the last few years. This is a high-quality business across the board, and with large economies of scale, pricing power, brand recognition, product specialization, and an expert workforce that guides consumer purchases, there are durable competitive advantages in place. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. Retailing is extremely competitive, limiting margins. Any major changes in the way consumers spend money can affect the business. One near-term concern is the possible pent-up demand for services, which could result in consumer spending flowing away from home projects. The company's stores are only in North America, which means no international growth potential at this time. A red-hot U.S. real estate market could correct at any time, which would likely negatively impact the demand for general spending on homes. I view these risks as very manageable, particularly if the investment is made at an attractive valuation. After correcting off of its 52-week high of $215.22, I see the stock as attractively valued here. The price-earnings ratio is sitting at 20.7. That's well off of its own 5-year average price-earnings ratio of 24.8. Admittedly, as I noted earlier, a pull-forward effect could be in play, but there's still a sizable gap present. That gap is also present in the cash flow multiple. The current price-to-cash flow ratio of 12.7 is quite a bit lower than its 5-year average of 14.5. I valued shares using a 2-stage dividend discount model analysis. I factored in a 10% discount rate, a 10-year dividend growth rate of 12%, and a long-term dividend growth rate of 8%. I'm assuming the continuation of low double-digit dividend growth for the next decade, as the company's strong underlying earnings per share growth and the low payout ratio can support this for years to come. While this might look high, it's actually almost 1/3 that of what the most recent dividend increase was. In addition, it's not a permanent expectation. I believe the dividend growth rate will settle into a high single-digit range, as that would be in line with what I customarily expect from a world-class retailer like this. The dividend discount model analysis gives me a fair value of $242.30. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Lowe's as a 2-star stock with a fair value estimate of $165. CFRA rates Lowe's as a 4-star buy with a 12-month target price of $220. I think Morningstar is being way too conservative here. Averaging the 3 numbers out gives us a final valuation of $209.10, which would indicate the stock is possibly 10% undervalued. Here's the bottom line, guys. Lowe's Companies Inc. is a world-class home improvement retailer that is benefiting from a huge trend that is playing out across the United States. With 59 consecutive years of dividend increases, double-digit dividend growth, a market-beating yield, a very low payout ratio, and the potential that shares are 10% undervalued, this Dividend Aristocrat deserves to be on every dividend growth investor's shopping list. And now for a special news announcement. T. Rowe Price Group Inc., stock ticker TROW, just announced a nice bump in their assets under management, up to $1.64 trillion for the end of July 2021. No doubt helped by the surging stock market. I called this a nearly flawless Dividend Aristocrat in a video we put out back in April, where I showed why I thought the stock, then priced at about $175 a share, was undervalued. It's now at $215 a share, and it could be headed even higher. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.